Welcome to Wall Street versus Main Street, a different take on the investment show with our host, Dax White. Dax White is the managing partner of the White Law Group, a national securities fraud, securities arbitration, and investor protection law firm with offices in Chicago, Illinois, and Vero Beach, Florida. The White Law Group has represented hundreds of investors in FINRA arbitration claims against their brokerage firms, and throughout this show, Mr. White will shine a light on some of the tricks of the brokerage industry, while also providing valuable information for investors on how to successfully navigate the investor-financial advisor relationship.
Welcome, everyone. You're listening to Wall Street versus Main Street. I'm your host, Dax White. As the lead-in indicated, this is a different take on the investment show. The objective of this show is not to provide investment advice. I'm not a licensed investment professional. Instead, I am a securities attorney who represents investors in claims against their brokerage firm. And the objective is to pass along some of the information that I've gleaned from that practice that I think would be valuable to investors to try to even the playing field a little bit in that relationship with your financial advisor, shine a light on some of the tricks they use to put you in products that maybe aren't in your best interest, and overall just to give information to investors that I think would be helpful to hopefully put them in a situation where they never need somebody like me. So that's the objective. Each week we'll tackle different topics that would be on point with the brokerage industry, and I'll give my perspective and hopefully pass along some information that will be helpful to you. This week we're going to do that through some questions that have come in that I think are both topical and will be relevant to lots of investors out there. So hopefully some of this information will be of use to you. But the first question that came in through our website, which is wallstreetvmainstreet.com, and certainly if you have questions, feel free to check us out there. But the first question that came in was from a reader that said that they had been reading about the Department of Labor possibly passing a new fiduciary duty rule for financial advisors, and what's my perspective? For those of you that don't know about what's going on at the Department of Labor, what they are trying to do is to unify and make uniform the standard by which financial advisors interact with investors. Right now, there are multiple standards, and unfortunately, investors have no idea really what their duty or what the financial advisor's duty to them is. There's registered investment advisors, which do have a fiduciary duty. And then there's broker-dealer financial advisors who have a suitability standard. So there's no fiduciary duty. So what the Department of Labor is trying to do is simply to make that uniform so that regardless of what type of financial advisor you're dealing with, the standard is the same. And that standard would be that they would have a fiduciary duty. And of course, the significance of that is in the difference between the suitability standard that currently exists and what a fiduciary duty standard would be. And the relevance of that, I think, is we see it all the time in our practice, but it's that the majority of investors out there, I believe, think that or assume that their financial advisor does have a fiduciary duty. And that is not necessarily the case. And in fact, most financial advisors would argue that their obligation is only the suitability standard. And so the significance, just by way of example, is let's say you go into your financial advisor and you say, you know, I'd like to invest in equities. If there's a fiduciary duty standard, the financial advisor would be required to look at all of the options to invest in equities, whether that be mutual funds or buying a basket of stocks that he or she picks, or low-cost ETFs. Look at all of those options and figure out which one would be the best for you. Because that's literally what a fiduciary is. It's someone who puts the interest of their client ahead of their own. Under the suitability standard, a financial advisor could simply look at the options that are out there, and there would be many to accomplish that very simple goal of I want to invest in equities. They could look at those and they could pick the one that pays them the most money. And they could argue that that is suitable. You wanted to be in equities. That's what this fund does. But they could pick the one that has the highest commission and pays them the most money. And that is a substantial difference between suitability and a fiduciary duty, because the bar is exceptionally lower. They still, in theory, have accomplished your investment objective, but they haven't put your interest first. And we see that fundamental problem in our practice every single day, because the vast majority of our cases at the root, whether they be having to do with stocks or bonds or private placements, whatever the investment is, at the heart of them is this confluence between greed and commissions and maximize and putting their own this inherent conflict of interest between maximizing commissions for the financial advisor and not putting the client's best interest at first. And to a T, every discussion that I have with investors talks about that discrepancy between their understanding of that relationship with their financial advisor and the brokerage industry's understanding of that relationship. Because I would say almost unequivocally that clients at least thought that the broker was looking out for them and didn't understand that it was just this suitability standard where, again, the broker could pick the one that just paid them the most money as long as it, fit the investment objectives and was therefore suitable. So what the Department of Labor is trying to do is to uniform that standard and raise the bar. And here comes the rub, because, of course, the brokerage industry is pushing back enormously. They're talking about how this would be substantially more regulation for them, which it would, but maybe it's necessary regulation. But they're talking about the cost of implementing it and the compliance that will be necessary, the additional compliance that would be necessary to make sure that the broker's recommendation is not just suitable, but also in the client's best interest. And there's a number of brokerage firms who have already spoken out and said, essentially, if this passes, we're not going to be able to continue to operate. The firms that have done it, interestingly, are primarily insurance companies that mostly push high-cost variable annuities. So, and it's almost an acknowledgement from the brokerage industry that we can say these are suitable for clients, but we can't sell them if we have a fiduciary duty to them. So, generally, I would be somebody who would lean towards less regulation from government, but this might be a situation where it would be necessary regulation because, again, there is a gigantic disconnect between what investors think the relationship with their financial advisor is versus what it currently is. And so this would be something where the Department of Labor would essentially be closing the loop, uniforming the standard, and making sure that your understanding, your perception is reality. So if that's something that's important to you, I certainly would encourage you to reach out to your congressman or your senator and let them know where you stand on that issue, one way or the other. But certainly voice your opinion, because that's something that's being discussed right now. And as I said, the brokerage industry is pushing back substantially, and frankly, they're well heeled. So it's interesting to me as somebody who tracks this, what will happen. Right now, there seems to be momentum behind getting this legislation passed. But things always get squirrely when you get towards the end here, and it would not surprise me one bit if suddenly you have a bunch of politicians coming out and saying, "Oh, I can't get behind this because of the cost of regulation and what this would do for brokerage firms." Because frankly, you would see a lot of consolidation, you would see a lot of players leaving the market. But in my experience, those are the firms that we're suing the most, as opposed to the ones who are already doing it the right way. And maybe that's a good thing. Maybe this would really help investors. I certainly think it would. The other thing in terms of my own perspective is sort of how we deal with this in the litigation context, because obviously we see fallout. We see after investors have already, been defrauded. And at hearings, while a brokerage firm attorney will always argue they did not have a fiduciary duty to my client, it is actually incredibly easy to prove at a hearing that they did, at least by course of conduct and by understanding. And generally, the way we do that is to simply put it to the broker in examination under oath. When you made this recommendation, were you looking out for yourself, or were you looking out for my client? And that's an answer that's a question that has no right answer for him or her, because if he says that I was looking out for myself, he's toast. The arbitrators are going to immediately make notes in their scribble, okay, that was an interesting admission. And so they very rarely are going to do that. They're not going to say, oh, I was looking out for me. They're going to say, oh, of course, I always put my client's interests first. When I make a recommendation, I make sure it's in their best interest. And when they say that, I simply show them the Black's Law Dictionary definition of a fiduciary, because that's what it is. And you get a lot of, argument from defense lawyers who get mad about that and say that he's not a legal professional. He can't come to that conclusion. But regardless, he just testified that, yes, I acknowledge that I put the client's interest first. And that, of course, is what a fiduciary is. So in the litigation context, I would say that generally, certainly we argue that there was a fiduciary duty by conduct there. The client certainly on our end will testify that they believe that there was a fiduciary duty. But again, I don't think a lot of people understand or realize or know that this is being fought right now in Washington, D.C., that brokers and the brokerage industry very much would deny that they have that standard to you, and they want to keep it at that lower bar of suitability, because then they can just make a recommendation that is, follows your investment objective, but is not necessarily in your best interest. So again, if that's something that interests you, reach out to your congressperson and voice your opinion. The second question we got, and I certainly also thought this was topical because there are probably a lot of people out there that this would apply to, was someone who weighed in and said, I want to fire my financial advisor. What's the best way to do that? This is one where, and it's not necessarily because it's in your best interest that they do this, but the brokerage industry actually makes firing and moving very easy. There's a process called the ACAT process, where the brokerage firm takes care of this entirely for you. You do not even need to go back into your old brokerage firm. If you've made the decision, you know what, I want to move my money, I don't want to deal with this person anymore. You don't have to have a face-to-face. You don't have to sign something. You don't have to go in and explain yourself. All you need to do is find a new financial advisor, go through the vetting process, certainly check out FINRA Broker Check at finra.org. We've talked about this in past weeks, where you can look up financial advisors and find out how they've done on their licensing exams, whether they've been sued, whether they've ever been fired by their firms, all those things that you would need to pick a new person. Do that. And once you've vetted and selected a new person, all you have to do is go there, set up a new account with them, and their brokerage firm will take care of it. Again, it's called the ACAT process, and they make it incredibly easy because, of course, new firms, and they're always trying to fight over assets and who has clients, but the new firm wants to make it as easy for you as possible, because they know if it's a headache and a hassle, you might not do it. You might say, you know what, I'm frustrated with my guy, but I don't want to spend 2 weeks dealing with this. I got other things to do. And so they remove that component. They make it very easy for you. That's why. But that's important for you to know, because maybe that is one of the reasons holding you back. Maybe you're sitting there going, I am unhappy with this person, but man, I just don't want to go through the hassle of switching firms. Like, is it going to make that big a difference? I don't know. The hardest part for you will simply be finding somebody new, finding somebody you're comfortable with. And obviously that's a very important decision. This is somebody who's going to be helping you, accomplish your retirement goals. Maybe they're going to be helping you with raising money for college educations, whatever it is that you currently need. It's obviously going to be important, but that's going to be the hardest part for you is finding the right person for you. But once you've done that, switching is actually very easy. The last question that we had, and this is sort of a general question, but someone asked, what are some of the red flags to look out for? Obviously we deal with fallout and with people who have already been ripped off. And so we're constantly helping people in litigation claims against brokerage firms because they've lost money. But what would be some of the red flags that would exist so that you could avoid being in that situation, avoid needing somebody like me? And there are a number, and there's just constant themes that we see from cases where clients are sort of beating themselves up, thinking, man, if I'd only known. I literally just talked to somebody yesterday after work who was in that situation where, he was beating himself up because he had a number of investments that had gone bad over the years, and just kept listening to the broker who told him, oh, don't worry, my brokerage firm's going to make that back for you, or, that investment that's in bankruptcy, whatever you don't get back after the bankruptcy is concluded, but bankruptcies take years, but whatever you get back, we're going to pay the rest. All these promises, all these representations that have now made his claim more difficult for me because it's old. There's statutes of limitation that might apply that would make it more difficult for me to bring the claim, just because, the case might get dismissed on statutes of limitation. And I was wishing he had called me sooner, and he was frankly beating himself up because he hadn't, because there were a lot of red flags that had he been keen to them, he could have potentially picked up on. But the first one that we see a lot of is when your financial advisor wants to meet you away from their office. I would say that periodically that is not necessarily a horrible red flag, but if it's consistent and every time, it's suggestive of a financial advisor who doesn't like the compliance at his firm, i.e. the compliance is too rigid, and whatever he's recommending or wanting to do is something he doesn't want them to know about or think that they would be okay with. So that's the largest problem. But it's suggestive of a financial advisor who's gone rogue a bit. It's not a bright line rule. I mean, if you're a financial advisor, if you and that person are more comfortable just having lunch once a quarter to talk about things, that's okay. But if you say, hey, can I come to your office? And they say no, that might be a red flag. So just keep in mind, the basic relationship here for financial advisors is, they've got back office compliance people, whether it be a supervisor, a branch, compliance officer, a bunch of other people internally that have to approve the recommendation. So if a financial advisor makes a recommendation for you to buy XYZ stock, there is a back office, fail-safe there for you, and to protect them from litigation, of course. But there is this process where that recommendation has to be signed off on by the financial advisor's boss. And so if they're out there trying to do business that their back office people won't know about, I mean, again, that is a red flag. That's something to be concerned about. Another substantial red flag, and I would hope this one would be sort of self-evident to a lot of people, but we see it all the time where the investor didn't think it was any big deal or any red flag to them. But when the financial advisor asks you to make the check out to them personally and says, I'll take care of making the investment for you, that's a huge red flag. I can't think of a situation where that actually wasn't a fraud. Brokerage firms, again, the back office compliance folks, would never allow that to happen. If you made a check out to the financial advisor and then he handed it to his branch manager and said, hey, I need this to be deposited into this client's account, they're going to reject that 100 times out of 100. So I can't think of a situation where it would be okay from a compliance standpoint or something where the brokerage firm was aware of it, because again, they just wouldn't allow it. Could there be a situation where maybe he's setting up a business that they don't know about, so he really shouldn't be doing it, but that doesn't mean he's going to steal your money or burn through your money or something like that? Sure. A lot of these guys, unfortunately, are sort of wheelers and dealers, and in addition to their financial advisory practice, they're also setting up this fund, that we're going to buy some real estate, or we're going to do this, we're going to trade options, blah, blah, blah. And they are required to disclose that to their brokerage firm, but they don't always do it. And could it be a completely legitimate business? And he says, write the check out to me and I'll put it in this fund. And could they do that? Yes. And could the investment work out? Sure. But I would say the vast majority of times when that's happening, it's usually some sort of either outright theft or some investment that they've got going that isn't panning out, and now they need to pay expenses and they need more money from their clients. And again, I've never seen a situation where the brokerage firm was aware of it. So I would say that's a huge red flag. You should not be making checks out to your financial advisor. And frankly, if they ask for it, even if it's a legitimate deal, tell them, look, I want to make the check out to the investment. And if they say, oh, I can't do that, then it is a red flag. There should be no reason why you can't make the check out to the investment. So that's a definite red flag. Another one would be if they are sending you documents not on the brokerage firm's letterhead. And we see this all the time as well, where they're sort of on their own personal letterhead, sending you summaries, telling you how your investments are going. That is one of the primary functions of the brokerage firm, is to put those reports together for you and to be sending you updates and letting you know how things are going. There should be no reason for the financial advisor to be the one that's doing that for you. And if they're sending you those types of summaries or sending you any kind of report that isn't on the brokerage firm letterhead or approved by the brokerage firm letterhead, that means they didn't look at it. And that means they don't know he's doing it, and he shouldn't be. That's another, or he or she, that's another instance where that would be a compliance no-no. The brokerage firm would certainly require that all correspondence that leaves from their office, from their financial advisor to an investor, be approved by them. So if the broker is sending you reports or updates or emails, talking about the investments, and it's not on his brokerage firm email, or it's not on the brokerage firm letterhead, that means they didn't look at it and it's not been approved, and it could be potentially a problem. The situation that we see a lot is where the summaries are completely fabricated, they're not remotely accurate, and they're all intended to lead you to believe that your investments are doing far better than they really are. And it delays your awareness of what's really going on. Maybe the financial advisor's hoping things will bounce back, and you'll never be aware that there was a period where things were going really bad. But it is usually to hide from you just how poorly these investments are going. So if you're getting summaries from your financial advisor and they're not on the letterhead from the brokerage firm, huge red flag. Another one is when they are evasive about how they're being compensated. We see this all the time where the financial advisor says, "Oh, don't worry about it. I'm paid by the investment sponsor." And they don't actually give you an answer. They don't say what the compensation is. That's a red flag. That is suggestive that the investment is actually very high commission, and they don't want you to know, because if you knew they were getting paid 7, 8, 9, sometimes 10%, you probably wouldn't do the deal. And so if they say, "Oh, don't worry about it. It's you're not the one paying me," that might technically be true, but you're being paid with your money, or he's being paid with your money. So if you make a $100,000 investment in a private placement, although his commission check might technically come from the investment sponsor, it comes out of that 100,000. So if the fee is 7%, which is very high, but we see that all the time, that means that you're really only investing 93,000. It's not the investment sponsor writing a check for $7,000 on top of your 100. It comes out of your money. So while technically that statement, which we hear all the time, "Oh, don't worry, you're not the one who pays me," yes, that's technically true, but they're being paid with your money. So in reality, it is actually quite destructive to your investment when you're paying that high of a commission. Another red flag, and these two are smaller, so I'll sort of run through them quickly. If they ask you for a loan, that's a red flag. Brokerage firms almost across the board do not permit that. If they're asking you for a loan, it's not approved by the brokerage firm. They're not aware of it, and they certainly aren't going to stand behind it if he defaults. You could sue them for failure to supervise and claim that the reason that you did that loan and weren't paid back is because he was breaching their own compliance, and they should have caught him. But they certainly will fight back on that, and they'll argue, no, that was an outside business activity that we were completely unaware of and had nothing to do with. So loans to the broker are prohibited. If he asks you for a loan, red flag. Last one, if you see a substantial change in trading pattern, that's usually a red flag. That's suggestive of a financial advisor who's got financial problems, and he's looking around at his book of business going, "Okay, where can I make this up?" We've had cases where there's a huge spike in trading right around when the financial advisor got married. And you could prove that it's because he had all these vendors he suddenly had to pay, and he didn't have the money. And so he went crazy in our client's account and generated enormous commissions so he could make some more money to pay for that. So if you suddenly see this huge shift in the type of trading that's happening in your account, there's probably a financial reason for that. So that would be another red flag. So those are the red flags that I see out there. Hopefully that answered the questions we had. We're going to take a quick commercial break and then wrap this one up.
Formerly of Bugmaster, now co-owner of Compass Pest Control, CompassPests.com. Compass provides a complete range of services, including lawn and landscape, termite prevention, and structural pest control for both residential and commercial clients. Find out why friends and neighbors are choosing a new direction and moving to Compass Pest Control. Call Compass at 772-413-1647 or visit CompassPests.com.
Complete Employee Solutions in Vero Beach wants to ask, what could your business achieve if you weren't taking up precious time with payroll, tax compliance, HR, and the like? If you're a small, growing business, it can be tough keeping up to date with increasing payroll and tax regulations. Without a proactive plan to help you manage your back office burdens, achieving your business goals could get sidelined. Hiring Complete Employee Solutions will allow you to have a paperless payroll and HR tools so you can improve compliance that will attract and retain valued employees. Save time and improve your bottom line. Complete Employee Solutions does paperless payroll and employee leasing too. Complete Employee Solutions. Join the team and feel complete. 567-6333.
Hi, Captain Kirk here from White Rose Limo, featuring sedans, limos, and party buses, doing everything from trips to airports and seaports to helping you celebrate milestones for 16 years. And now on Friday nights, please join me on a happy hour tour, making the rounds all over town in an ongoing quest to find the best happy hour. Reserve your seats at White Rose Limo, 772-283-5133. White Rose Limo.
Welcome back, everybody. You've been listening to Wall Street versus Main Street. If you've got questions you want us to answer on a future program, check us out at wallstreetvmainstreet.com or tune in next week. We'll be talking about 2 new investments I've seen out there that are blowing up and that you certainly would want to avoid. Thanks for listening.
You've been listening to Wall Street versus Main Street. The views expressed by the participants of the program are their own and do not represent the views of, nor are they endorsed by, the White Law Group, its officers, directors, employees, agents, representatives, shareholders, nor any of its subsidiaries. None of the content should be considered legal advice. As always, consult a lawyer.